Hello, and welcome to another episode of the Profit Minds podcast. I'm your host, Dr. Stephen Kirch, creator of the Profit Minds Growth System, a unique blend of profit growth, productivity acceleration, and building robust business process for scale. In every episode, I interview entrepreneurs and small business owners from around the world with a unique story to tell. You can find the show on YouTube, LinkedIn, Apple and Google Podcasts, Stitcher, Spotify, and more. Well, hello, everyone. Today, my guest is Robert Rolih, international best-selling author, entrepreneur, and financial educator. And today, we're going to talk about how to take back control of your financial future. Welcome, Robert.
Hi, it's a great honor to be here.
So, the first question I ask everybody, tell us your story. How did you get here?
Yeah, it's an interesting story. I grew up in a backwater village in Slovenia. This is a tiny country near Italy. And at that time, it was still a part of the communist bloc. So my parents were blue-collar workers, and money was always in short supply. I can still remember my father. He was a very tough guy with this Jimi Hendrix hairstyle. Whenever I asked him for something, he said, "Robert, we don't have any money. Money doesn't grow on trees." So that was the story of my growing up. And then when I was a student, I started my own business from scratch. And after 5 years of hard work, my company started to produce a lot of profits. And at that time, I knew that I should invest, but I was totally financially illiterate. And that is why I trusted financial advisors and investing gurus. And after years and years and years of giving them my business profits, my wife, Sarah, said, "Robert, I know that you trust these guys, but maybe let's just check where we stand financially." So I ordered all the account statements. And when they arrived and I opened these envelopes, it was like, what? Are there some zeros missing? Money that I worked hard to earn was mostly gone. And that was the start of the most depressing period of my life. I became depressed. I lost my motivation to work. It was really a very dark period for me. But even though I was totally devastated, luckily I was able to turn things around, and I realized that I need to take control over my money and investing. I should never, I always say, the person who controls the money wins. So you should never give control over your money to financial advisors, to bankers, to gurus. You should always keep control over your money and investing, because nobody will take care of your money as good as you will, if you just have the right knowledge. So, yeah, I realized that their interests, the financial industry's interests, are not aligned with our interests as investors. And this was a very, very, very expensive lesson for me. But of course, this also led me to where I am now. Later, because I learned all these things, all these details, I wrote my book, The $1 Million Decision. I started to conduct seminars, webinars. I created online courses, and now I'm helping people, to take control over their personal finance and investing, and of course, greatly increase the profits, the investment profits that they are getting over the long run.
Yeah. So what's the decision that you need to make, the $1 million decision?
Yeah, this decision is super, super simple. The core message of the book and everything that I do is that small fees you pay when investing can lead to big financial problems. In the book and in my seminars, I show how even a regular investor, someone investing just 5,000 or 10,000 per year, can easily lose over $1 million by the time they retire. Why? Because of the hidden fees. The financial industry calls these fees management fees, and these fees, even they don't look dangerous. They are very small, but they compound over a long time period. They compound and they rob you of your financial future, and that's the key message.
Yeah. So um, how do you avoid those fees?
Simple. It's very simple. You just invest, for example, most of my investments go towards low-cost ETFs. These are funds that have the lowest possible fees, commissions and fees, and the financial industry takes just a little bit out of your money every single year when you invest in low-cost ETFs.
Yeah.
And you invest in basically a big basket of stocks for the lowest possible fee. And this leads to the best possible outcomes, the best possible profits over the long run. Because when you pay these small fees, for example, if you have a just 1% management fee, this really can destroy your wealth over the long run. But people don't realize it because we just think, okay, it's just 1%, but it's never just 1% because this compounds every single year. You are paying these fees, and this compounds and compounds, and in the end, it's a huge amount of money that is being taken from your accounts.
Yeah. So it's not a matter of you can't avoid them completely, but it's a matter of really paying attention to.
You just need to lower them as much as possible. Yeah.
But how do you find out if I'm an investor? How do I find out what I'm paying right now?
You need to check. And you need to pay attention to management fees. Okay, so management fees are the most important fees because they charge these fees every single year. So, for example, if you are paying 1% management fee, and if you have an account, let's say that you have an investment account of $100,000. Okay, small account.
Makes the math easy. Yeah.
Yeah, so if you are paying 1% management fee, this is 1,000 out of this 100,000 every single year. But because this 1,000 doesn't grow anymore in your account, this basically compounds over a long time period. So, for example, if you invest for 30 years, so if your time horizon is 30 years, let's say that you are, I don't know, 40 years old now, and you will retire when you are 70, this will compound over 30 years. And this 1% will grow and it will cost you more than your initial starting point, $100,000 over these 30 years. So it's really people don't realize that small management fees can lead to really big financial losses over time. And that's if you compare, for example, mutual funds that charge high management fees, and you compare them to index funds or ETFs that charge very low management fees. Over a long period of time, for example, a 10-year period of time, I just did the comparison of two similar funds. One is mutual fund and one is ETF over the last 10 years, and they are both investing in the same basket of stocks. And the growth for ETF, the low cost ETF, was almost 200%, and for 300%. And for the mutual fund, it was less than 100%. So it's a huge difference. It's a huge difference when you account for all these fees. It can easily mean that it can halve your investment account over a long period of time if you are just paying 1% management fee.
Okay. So do you recommend that people manage their own money as a part of this?
Yeah, and it's very simple. My wife, for example, she uses a very, very simple strategy. She just invests in a simple global stock index fund or ETF. And this is how she is exposed to the global economy. Most of the global economy is, of course, US economy.
Yeah.
And she just invests in one simple ETF, and that's it, So it can be very simple. It can be very simple. And she has been outperforming even Warren Buffett, over the last more than 10 years. Because when you are exposed to the entire stock market for the lowest possible fee, you mathematically outperform 95% of investors out there. Okay, and also you outperform all the short-term speculators, you outperform all the short-term traders, and so on. So it's simple math.
Wow. So how does somebody get started? What's the way,
Yeah, so
how
it's
you,
simple,
you
you
because
just need to open
there's
your brokerage account.
yeah, there's hundreds of ETFs, right? How do you decide,
Yeah,
and how do you?
you just choose something that is connected to S&P 500 or global stock market. You just pick something that represents, let's say, U.S. economy or global economy, and that's it. So, for example, a simple S&P 500 ETF is always a good choice, and the management fee for such funds is less than 0.1%. Usually it's like 0.05% or 0.04%, almost nothing. Okay, and compare that to mutual funds that have 1% management fee or 1.5% management fee. This is a huge difference.
Yeah.
Okay, and it compounds over time.
Yeah. So, and do you recommend a certain level of diversification in that as well, or do you just simply choose one and set it and forget it?
Yeah, so if you are investing in some kind of broad index fund like S&P 500, this is more than enough diversification because you are exposed to all the industries, you are exposed to 500 biggest US companies, and that's more, that's more diversification that you will ever need.
Yeah.
Of course, you can then diversify a bit of your portfolio into Bitcoin. Bitcoin is a great asset to own in the long run. I believe. You can also invest a bit in bonds, even though bonds, in the last period of time, they have not performed well because of all the money printing and so on. You can also diversify into other things, but most of your the major part of your portfolio or major part of my portfolio are always index funds, stock index funds. Yeah.
Okay. Yeah. And what about diversification globally? Do you worry about the fact that the U.S. economy may be working in a different direction from other economies?
Yeah, that's a question that I often get, and my answer is simple. If you invest in S&P 500, for example, companies, you are investing in global companies. Because Google and Amazon and Facebook or Meta, they are doing business all around the globe, and this is more, this is how you are exposed to the global economy, because all the tech giants and technology ate the world in the last 20 years, and it will probably be eating the world also in the future. All the tech giants are from the US because the US has the best environment for companies, and I don't see this changing anytime soon.
Okay. So what's the what's the best way for somebody to, I'll say, what's a good strategy again to you want to grow this over time? Do you invest a little bit every week, every month? How do you do that?
Yeah, that's a good question. So all the research, all the stats are saying that if you just regularly invest, you are using dollar cost averaging. This means regular investments over time. So, for example, if you just invest once per quarter or once per month, or I don't know, once per week, whatever, is your financial situation, you will do amazingly well, because you will also invest when the markets go down, and these are the best times to invest, of course. So when everybody is panicking, I'm the happiest investor out there. For example, when we had in April 2025, when we had Trump tariff panic, everybody was scared. The stock market went down 30%. Everybody was panicking. It was the end of the world. Recession is coming. Tariffs will destroy everything, and so on. We were investing heavily. At that time, I told my members, I told my audience, yeah, I'm investing now. I'm investing now. I'm investing now, because these are the best periods, So when the markets go down sharply, I'm the happiest investor out there, because I'm buying heavily.
Yeah.
But like I said,
Yeah.
regular investments are the way to go. If you don't want to worry about market timing, and people are very, very bad at market timing usually, because everybody wants to invest when things go up, and nobody wants to invest when things go down. For example, just 1 month ago, everybody wanted to invest in gold because it was like skyrocketing. And now, of course, when it has a correction, very few people want to invest in gold. So it's human nature, and it's very, very hard for everyday investor to time the market, almost impossible. And that is why it's much, much, much better to just invest regularly, pick a period, pick 1 month period or bi-monthly or quarterly, and just do it, and that's it.
Yeah. What about on the other end? Eventually, you want to be able to reap the rewards of your growing financial uh, assets, right? What do you recommend there in terms of pulling money out?
Yeah, this is uh, depending on a person, every person has its own needs. So if you need money, of course, take it out, sell something. But if you don't need that money, it can just compound, compound, compound. And you, of course, when you retire, you will gradually start to sell your investments, because you will need that money. But up until that moment, you can just invest, invest, invest. Of
Mm,
course, if there is a situation when you need money to buy, maybe you have something, maybe you are buying an apartment or a house or whatever. Of course, you will sell some of your investments, but otherwise, you just invest, invest, invest up to the point when you retire, and then you gradually sell.
okay. Is there a particular strategy that you recommend for the withdrawals? Is it the same kind of dollar cost averaging that you do there, or?
Yeah, of course, you should never overdo it. So, for example, one of the rules of taking money out when you retire is that you should never take out more than 4% per year. So, for example, if you have a portfolio of 1 million, when you retire, you should never take more than 40,000 out of your portfolio in a single year. Because if you do that, if you take more, you risk running out of money, and that's not a good thing.
Yeah, yeah, that's right. Yeah, good. So, do you have a free gift or offer for our listeners that have made it through to this point in the conversation?
Yeah, I prepared the online masterclass. This is a very, very content-rich masterclass. It's an online masterclass. It's 90 minutes, and I teach all about how fees affect your long-term returns. I talk about my best investments for the coming period. I talk about the number one strategy long-term investors use to increase their returns, and also I talk about this what I call reverse psychology of investing, how to invest when everybody is panicking. And using this strategy, for example, we invested in Bitcoin when it was at around 16,200. Of course, then it went up to 100,000 and even higher. But that was the moment when Jim Cramer on CNBC was telling people, get out of crypto, sell your Bitcoin. And that was the moment when I was heavily when I was starting to invest heavily in Bitcoin, for example. So yeah, it's a free masterclass where I teach all these things, and you can just go to robertrolih.com and there you will see it's at the top somewhere. Okay, so it's Robert ROLIH.com. ROLIH.com. Or you can just enter Robert Rolih in Google and my website will pop up.
Great, great. And what's the best way for people to get in touch with you?
Yeah, they can go to my website, and there is also a contact form on the website. So if you have a question for me or whatever, you can just use the contact form on my website, and I will definitely get back to you usually in 24 hours.
Great. And that concludes our show. Thanks so much to my guest, Robert Rolih, international best-selling author, entrepreneur, and financial educator. I hope you learned something about how to take control of your financial future. I know I did. Thanks for listening. You've been listening to the Profit Minds podcast. This is your host, Dr. Stephen Kirch. Please visit www.profitminds.net for other episodes or to contact me. Thank you for your positive feedback, comments, questions, and for sharing this show with others. Thanks for listening. Have a grateful day.